There's a belief that underpins a large percentage of real estate decisions in Lagos. It sounds logical, it sounds conservative, and that's why it's dangerous. The belief is this: if a property is in a good area and prices in that area are rising, then the investment is safe. Most investors don't say it out loud, but they act on it consistently. In 2026, this belief is quietly eroding investment performance, not because Lagos real estate is weak, but because the assumption behind safety is outdated. So today, I want to examine this myth clinically, not emotionally, and show why it is no longer a reliable decision framework. This myth didn't come from ignorance, it came from historical accuracy. For a long time, Lagos real estate behaved like a blunt inflation hedge. Population growth was aggressive, supply was inefficient, pricing was loosely correlated to utility. In that environment, being in a good area reduced downside risk. Holding long enough almost guaranteed nominal gains, and poor asset selection was forgiven by micro forces. The market rewarded participation, not precision. So the myth worked, at least then, but investment logic is always time-bound. What protects capital in one phase becomes a liability in the next. Lagos real estate has entered a phase of segmentation. This is a critical shift. Prices are still rising, but performance is diverging. The market is no longer pricing cities. It's pricing micro markets, demand bands, and use cases. In this environment, two properties in the same neighborhood can deliver radically different outcomes. Appreciation no longer compensates for weak fundamentals, and liquidity becomes conditional, not assumed. This is how investors lose money inside a rising market, not through crashes, but through opportunity costs, yield erosion, and illiquidity. Let's examine how this myth expresses itself in real decisions. First, overpaying for prestige. Investors accept compressed yields because the location feels safe. Secondly, fragile rent assumptions. Properties are priced at rent levels that depend on continuous upward pressure, not sustainable demand. Thirdly, liquidity illusion. The belief that someone will always buy this ignores the narrowing buyer pool at higher price points. These decisions don't look reckless, they look reasonable, and that's the problem. This is a critical distinction most investors fail to make. Market growth does not equal asset safety. Rising prices only protect you if demand remains deep at your price points, if replacement buyers exist, and if your assets can adapt to tighter conditions. When these fail, appreciation becomes irrelevant. You don't lose money because prices fall. You lose money because your asset stops being competitive. That's a very different risk. So in 2026, safety is not a location descriptor, it's a performance characteristics. A safe property now has demand depth. Multiple buyer and renter profiles can absorb it without stress. Affordability elasticity. Small economic shifts don't break demand. Operational resilience. Vacancy, maintenance, and pricing pressure don't collapse returns. Exit realism. You can sell without relying on market euphoria. Safety is not about how impressive the property is. It's about how many ways it can fail and still survive. The myth persists because it offers emotional comfort. Prime areas feel familiar, they feel validated, they feel socially approved, but comfort is not a financial metric. In fact, comfort often correlates with crowding, and crowding compresses returns. Experienced investors don't lose money because they lack information. They lose money because they stop questioning assumptions that once worked. The most expensive mistakes in Lagos real estate over the next decade will not come from bad locations. They will come from lazy definitions of safety. From assuming rising prices mean protection, to prestige means resilience, to familiarity means low risk. In 2026, real estate rewards precision, not participation. And the investors who outperform will not be the loudest. They will be the ones who quietly redefine their frameworks before the market forces them to. As usual, if you found this insightful, don't forget to comment, like, share, and subscribe. See you in the next one. Bye for now.